If you're a traditional asset manager like a pension fund, you have found yourself in a very, very unusual and unprecedented place in this market. It's no secret that we are at historical yield curve levels, and matching your liabilities and your assets and your returns has become increasingly difficult to do. So here with me today is Pierre Koch, the buy-side business development manager from Misys, to discuss shifts in transparency and risk views and the toolkit underlying that, and really the drivers behind what these traditional asset managers, the challenges they face, and the needs that they have to navigate the road ahead. So Pierre, I thought we'd start with just having you paint this picture of you're sitting there, you're a pension fund. What's your reality like in this market today?
Right. So pension funds over the last few years had to de-risk their portfolio by moving away from equities into fixed income, where they're now in a very low yield environment, as you said. So they're facing a funding gap on the one side and a need to generate alpha. One of the ways to do that is currently to invest into alternative investments, whether that's hedge funds, whether that's private equity funds, real estate funds. And there's a need to diversify into that kind of asset classes while keeping their core investments in equities and fixed income. The interesting need is in the ability to access and to view these portfolios made of very diverse asset classes in one single place. There's always a growing focus of accessing this information in one single place.
And this is a significant functionality gap given the toolkit today versus the needs that they have to go forward?
Yes.
I mean, where's the change primarily?
I guess the gap is essentially in the best of breed approach of having systems to manage these alternative assets and other systems to manage the traditional assets. So there's a need to bring everything in a single place on the one side, and on the second side to bring transparency into these alternative investments, to mix them with your equity portfolios or your fixed income portfolios.
So now you've expanded the spectrum of underlying positions and essentially the risk, but you've also introduced some new complexities in terms of measuring those risks. What then is the next, now that you've widened the lens, so to speak, what's the next challenge?
So the next challenge is actually to look through into these underlying investments. An interesting thing also to think about is this funding gap that I alluded to at the beginning. There's an increasing focus in matching your asset portfolio with your liability portfolio. How do you make a conscious decision in making sure that your cash flow projections are in line, that your sensitivities are in line on the asset liability matching portion of your portfolio? So the alternative assets will come in the revenue generating portion of your portfolio. So you have to unify all this view on risk, all this transparency on risk across your positions.
So now this is not something that, I mean, the current toolkit doesn't have this unified view. You have to go to different places to measure different risk. What's the pain point?
Right. That's exactly what you said. Another thing is in the different views of risk. There are two schools of thoughts in the traditional asset management risk. So risk has always been an integrated part of the investment decision process. However, there's the first school of thoughts with a factor-based model approach. And there's the other school of thoughts of a pricing model, a derivatives model approach, which actually Misys comes from. So we're seeing a disconnect between these two worlds. In June, there will be a very major release coming out for Misys, which will unify the approach of the factor-based model vendors into Sophis and try to bring in a single place to end users a different view on their risk in a single environment.
I want to try and cover one more quick topic before we wrap up, and that's the impact, and we're seeing this across the board, not just with the pension funds and traditional asset managers, although they're sort of central to this, but really across all demographic subcategories is the impact of collateral, measuring collateral, stress testing, changes in collateral values. How does this come into play into this overarching shift or the capability gaps in the toolkit?
Yes, I think it all comes down to the fact that the front office is changing. Yeah. Some of the things that were initially or formerly taken care of by the middle or back office are progressively being pushed up or exposed to the front office. So portfolio managers want to understand the impact of a trade on their margin requirements, on their funding costs. What does this trade do on my margin requirements? What if the market changes? What if I stress test my portfolio? How do I see the impact on my cash projections and margin requirements? Similarly, investment accounting. What does this trade do from an accounting point of view? T+1 is often not enough right now.
Well, and when we were discussing this earlier, there are some nuances between the different rules. I mean, depending on where you're located, right, you may have to comply with different jurisdictional. Go into just mention that.
So there. I mean, some funds need to report in their local GAAP and in IFRS. So. Yeah. Depending on how you trade and what you trade, it may have a different impact on your amortization or provisions. Again, how do you expose that to portfolio managers? How do you make them conscious of their investments from an accounting point of view?
Excellent. I want to bookmark there. We're talking about expanding views of transparency and risk for the road ahead. I'm here with Pierre Koch from Misys. Thanks for watching.